In my experience, when the gold and silver price decouples, that the silver price outperforms the gold price about 2 to 1. From a conjectural perspective, then, if I was one who believes that the gold price should go up threefold in the next 10 years, that would suggest that the gold price goes up sixfold. I'm just repeating history as I've lived through it. I personally save in gold. I invest in high quality gold stocks. I'm willing to take operational risk in those companies because I believe that an increase in the gold price increases their margins faster than it increases their cost. And I speculate in higher risk, lower quality gold companies.
In this insightful discussion, veteran investor Rickrule breaks down one of the most important signals in the precious metals market, the decoupling of gold and silver prices. Historically, when silver begins to outperform gold, it often does so by a factor of 2 to 1. This pattern has repeated through multiple market cycles and may be setting up again today. The analysis points out that if gold were to rise threefold over the next decade, a move that many see as entirely possible given current monetary trends, then silver could surge as much as sixfold. This ratio underscores silver's dual nature as both a monetary and industrial metal, giving it explosive potential in times of inflation, supply strain, and global de-dollarization. The conversation also explores strategic positioning, saving wealth in physical gold for security, investing in quality gold mining companies for leverage, and speculating selectively in higher-risk exploration stocks for outsized gains. This is not just theory. It's a perspective born from decades of market experience and a deep understanding of cyclical opportunity in metals. The message is clear. When gold and silver decouple, silver often leads the next major bull run. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on gold, silver, and the markets.
In the decade of the 70s, and by the way, I was around and in the game then, that decade was spectacular for gold. It went from $35 to $850. Many people don't remember that in the middle of that bull market in 1975, we had what I would call cyclical decline in a secular bull market in 1975, where the gold price fell by half and the prices of gold equities were even more dramatically impacted. People who got shaken out missed an eightfold increase in the gold price over 5 years. So it's important that if people are moved by the arithmetic behind my thesis, that they understand that they will have to endure both volatility and cyclicality. There will absolutely be a time in the next 10 years where the gold price falls momentarily by 20 or 30 or 40%. That will occur. Understanding silver supply is hard because silver mostly doesn't come out of silver mines. It comes out of recycling or gold mines or copper mines or lead mines or zinc mines. So to understand supply in silver, you have to focus less on the price of silver and more on supply and demand for things like copper, lead, and zinc. So getting an accurate supply handle is hard. It's hard too because a whole bunch of silver doesn't show up anymore anywhere. A whole bunch of silver is owned by private owners in India, Pakistan, Bangladesh. They don't want to be taxed on it, so it's unreported. When the price of silver, particularly in US dollar terms, goes up and the rupiah falls against the US dollar, times like right now, incredible price escalation in Indian terms, and that sometimes leads some supply to come out on the market. And the demand side has been hard for me to understand. What I know about the demand side as a monetary metal is this. Precious metals bull markets are led by gold, always. They're led by the fear buyer. And the price escalation has to do with the absence of selling, which is to say the sellers get used up. And when the fear buyers emerge, they can take the price of gold up relatively rapidly. Right. When the price action in gold, when the momentum in gold has justified the hard money narrative to generalist investors, not precious metals investors, but the generalist investors, which is precisely what you're seeing right now. Bank of America, Merrill Lynch, Goldman Sachs, all those guys. Yeah. When the generalist investors come into our space, precious metals, leadership changes from gold, from the fear buyer, to silver for the greed buyer. I don't know why this is, Darcy. I suspect it's because of the lower unit cost. or perhaps because of silver's reputation for volatility, or both. All I know is that in the three precious metals bull markets that I've survived prior to this one, at some point in time when the generalists came into the space, silver began to outpace gold. The last 4 or 5 weeks might suggest that we're in that period now, leaving the last week out of it. It's important for people to realize that gold's already up 12-fold since the year 2000. So I'm not, and also realize that in the 1970s, part of that move was due to the fact that gold had been price controlled. What I'm suggesting is that the nominal price of gold, the US dollar price of gold, probably mirrors the decline in the purchasing power of the US dollar. Will gold increase threefold or fourfold? I don't know. My crystal ball is cracked and cloudy. It only makes arithmetic sense that gold priced in dollars will increase if you have $1 million worth of gold, and like me, you've been buying it since the year 2000. You don't want to sell it because it's a store of value, but also you don't want to sell it because you don't want to pay the capital gains tax. Correct. But let's say the opportunity comes up to put a down payment on a distressed duplex or triplex in your neighborhood. You really want to buy this thing, but you don't want to sell your gold. Fine. Borrow against your gold, buy the duplex or triplex, improve it 4 or 5 years out, finance out of it, and repay the loan. It's designed to allow prudent investors access to the capital that they have tied up in their physical gold and silver without making them sell their physical gold and silver.
In this insightful segment, Rickrule reflects on the powerful lessons from past precious metals bull markets, particularly the explosive decade of the 1970s when gold soared from $35 to $850. He explains how even within a long-term uptrend, sharp corrections are inevitable. During that era, a 50% drop in gold's price shook out impatient investors, but those who held on witnessed an 8-fold increase in just 5 years. The message is timeless. Volatility is the cost of participation in a secular bull market. Rule also explores the complex dynamics of silver supply and demand, noting that most silver is produced as a byproduct of other metals like copper, lead, and zinc. This makes supply less responsive to price changes and harder to track, especially given unreported holdings in nations like India and Pakistan. As the fear-driven phase of gold buying transitions into the greed-driven silver stage, history suggests silver may once again outperform. With generalist investors returning to precious metals and the US dollar's purchasing power in decline, the setup echoes past cycles. Let's get into the interview.
Gold is a small business. The guys at Goldman Sachs just very recently learned how to spell gold, despite the fact there's only 4 letters in it. Our bank has been formed by and for, among other things, gold bugs. There are now 19,000 people on our wait list before we even open the bank. We know how to talk to the gold community, and we are right now the only bank in the United States that I know of that will establish credit facilities against bullion inventories in amounts less than $10 million. Our competitor is JP Morgan Chase, who has, as I understand it, a $10 million minimum. We will have a $100,000 minimum, and we will lower that as we get scale. So I would suspect that for our community, the 505,000 Americans who pay for investment advice as an example about gold, that we'll be the leading practitioner in this business. It won't be an afterthought for us. I save in gold. I think of it sort of as an insurance product, but insurance against the depreciation, the purchasing power of the US dollar. I maintain liquidity in dollars, in very, very short-term treasuries, but I personally save in gold. I invest in high-quality gold stocks. I'm willing to take operational risk in those companies because I believe that an increase in the gold price increases their margins faster than it increases their cost. And I speculate in higher risk, lower quality gold companies. So the gold sector fulfills all 3 roles for me. I save, I invest, and I speculate across those 3 asset buckets within the so-called gold group. Silver is both a monetary metal, I believe, and an industrial metal. People who are making a case for silver as a monetary metal forget the fact that the increased nominal price of silver reduces its utility in industry, and the increase in the price of silver reduces its industrial demand and cannibalizes that demand. At the same time that on the monetary side, silver is a Geffen good. which is to say that as the price increases, that increase in price validates the narrative. It's a
Right.
very, very odd metal. I've studied the silver market for 50 years.
In this powerful conclusion, Rickrule outlines how the precious metals market is evolving, not just as an investment, but as an entire financial ecosystem. As traditional banks like JP Morgan Chase cater only to multi-million-dollar bullion accounts, a new generation of institutions is emerging to serve serious gold investors at a more accessible level. With tens of thousands already on waiting lists, it's clear that the demand for sound money solutions is accelerating. Gold, he explains, is more than a commodity. It's insurance against the erosion of the US dollar's purchasing power. It represents savings, liquidity, and long-term stability all in one. Rule divides his approach into three roles: saving in physical gold, investing in high-quality miners, and speculating in higher-risk exploration companies for growth potential. He also explores silver's complex identity, both a monetary and industrial metal, noting how rising prices can validate its narrative even as they limit its industrial demand. This paradox is what makes silver so fascinating and volatile. For those seeking real diversification and tangible wealth preservation, this is essential insight. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on gold, silver, and the markets.